Humans, like dogs, have a deeply ingrained reflex. When we acquire something of value, we want to hide it in a safe, static location. Static cash held in a drawer or a zero-interest account undergoes an immediate and invisible decay as inflation eroded its future utility. This chart shows how inflation erodes purchasing power over time. If savings stay entirely flat at 0% growth, but the baseline cost of groceries, housing, and gas increases by an average of 3% every year, a mathematical gap opens up. Because of that expanding gap, a person doing absolutely nothing with their money can afford fewer goods this year than they could the year before. Passive hoarding mathematically guarantees financial loss. Surviving the modern financial landscape requires moving that capital into an active growth mechanism. Instead of hiding capital in cushions, investing requires treating it like a seed. You plant a small amount of value today into a productive asset. This graph demonstrates the structural countermeasure to inflation. By allocating assets into vehicles that historically yield a 6 to 8% annual return, the growth rate easily overtakes the 3% inflation line. The shaded area between those lines is actual, realized wealth. This process is entirely dependent on a long-term timeline. Unlike traditional saving, where cash is immediately accessible, capital growth requires years to compound efficiently. Regular market participation acts as an essential mathematical defense, ensuring the value of a lifetime's work isn't erased by systemic price increases. Deciding to invest immediately introduces a practical hurdle, figuring out how much daily effort, research, and expertise you actually need to apply. The active strategy demands intense, continuous labor. It involves poring over corporate earnings reports, trying to predict market movements, and timing purchases perfectly to catch a stock on a dip. The passive strategy abandons the attempt to outsmart the market. It relies entirely on setting up automatic, recurring weekly contributions, ignoring market conditions and the news cycle entirely. This set-it-and-forget-it approach is called dollar-cost averaging. You buy the exact same amount on the exact same day every single month. By stripping human emotion and exhaustion out of the equation, dollar-cost averaging consistently yields better long-term returns than frantic active trading. The stock market inherently carries risk. Tying your entire net worth to a single company means a single product failure or scandal can wipe out your capital entirely. The primary structural defense against that specific failure is diversification, spreading capital across a wide range of assets, so no single collapse is fatal. This diagram illustrates how broad index funds achieve this. Instead of holding one large position, an index fund buys a fractional piece of the top 500 companies in the market, instantly absorbing and distributing the risk. While a traditional index fund has a single price updated once at the end of the day, an exchange-traded fund, or ETF, holds that exact same basket of 500 companies, but trades continuously throughout the day, causing its price to fluctuate by the second. Utilizing broad market diversification shifts the act of investing from a high-stakes, all-or-nothing gamble into a highly calculated, statistically stable strategy. The math behind compound growth is flawless, but it requires a human to implement it. Human panic, anxiety, and impatience are the real threats to wealth generation. The first critical error is investing money required for basic survival. Tying up rent or grocery cash inevitably forces premature withdrawals, breaking the necessary long-term timeline. The second error is the expectation of rapid, overnight wealth. Compound interest is slow and methodical. Expecting quick returns leads to excessive risk-taking. This chart visualizes the damage of market panic. When the market inevitably crashes, the instinct is to flee, but selling at the exact bottom of a temporary dip permanently locks in those losses, missing the mathematical recovery entirely. Accumulating capital doesn't require predicting the future. It requires the emotional discipline to build an automated system and simply leave it alone during a crisis. Decades of consistent, passive, and diversified compounding eventually yield a self-sustaining asset base that outgrows the initial contributions. Automation defeats the hidden tax of inflation. Broad market distribution absorbs volatility, and leaving the system alone outsmarts our own destructive impulses. Building real, durable wealth is highly accessible and remarkably boring. It relies entirely on patience rather than frantic hustle.